Can your portfolio handle a 20 or 30% market drop? Well, mine can. Hey guys, it's Doug the Retirement Guy. Welcome back to the channel. Are you prepared? You're hearing a lot of this. You're hearing a lot of people talk about it. You're hearing different things. Now, I know it's always the negative because we've been in such a market, a positive market for so long, that we're going to have a major drop. We're going to have a major correction. That could be 10, 20, 30% they scare us with. Well, you can be scared or you can plan. You can be scared and react, or you can prepare for long term down the road. And that's what I've kind of done with my funds. I've put some safety into them, and we're going to break it all down today. So grab your favorite mug, grab your favorite beverage, fill it up, and be prepared to learn something today on our channel. Let's get with it today. Hey, before we go too far, I got to do that important disclaimer that this content is for educational and entertainment purposes only. It's not financial advice. Past performances do not guarantee future results. If you need a financial advisor, always contact a professional. Hey guys, before we dig any farther, I got to thank you for the support of the channel. You guys are phenomenal. Here's the thing. I do this as an unbiased program. I don't take sponsorships. I don't promote any particular product or brand. I just live off of my dividends and help you do the same. That's why I made Retirement Made Easy, living on dividends. 2 ways to support the channel with our coffee mug program, 11 ounce and a 15 ounce, easy to order. Use the QR code or the link down below. And it does help support the channel to be able to put videos out like this on a regular basis with some high quality for you. Also, our 40 ounce travel mug, we already sold out the first batch. We've got our second batch already in production. That's almost completely gone. So don't be afraid. Order yours today. We will ship them out ASAP. As soon as we got everything rolling, these things will virtually leave in the same time frame. But this all helps the channel. And if you've ordered yours, they're on their way. Thank you for your support. And we appreciate what you do for us as we do for you. So is your portfolio prepared for that 20 to 30% market drop? Well, we're going to show you 2 funds that really can give you some protection down the road. So the retirement portfolio question is, the concern is not just temporary losses. It's being forced to sell while markets are down. And that's what so many financial advisors force people to do. They're into growth, and growth. And they forget about the income side because they don't make money on the income side. They make money on the growth side. So what happens is you're forced to sell to continue your living expenses and so on. You're forced to sell funds to generate income to pay your bills. So a $500,000 portfolio during a 30% decline, you'd lose $150,000 of your net value. $1 million portfolio would be down $300,000 if we had a 30% decline. So what we're going to do is, conditional does not guarantee anything. Okay, we're going to show you some auto-callables funds that when the market prices can still decline and these things can still produce income down the road. So the 2 funds we're going to talk about today. Now there's a bunch of these, but these are the 2 that they're newer to the marketplace. Now callables have been out there since 2013, somewhere right in there. So these are 2 that I just did the research on. I liked what I saw. I thought I'd share it with you guys. But this is the Nasdaq Autocallable Income ETF, CAIQ from Calamos, and then the CAIQ, and this is their growth ETF. So we give you both income and growth in this video. But first, let's understand what autocallable basics really are, because these things are not your normal ETFs. These are not your things that you're just going to look at and say, what's the yield? What's the growth? And Doug always tells me, what's the total return? And you're going to understand it, because these things operate more like a bond fund than a index stock type fund. So they're really different sides of it. And these guys have really done a great job of how they structure it, and we'll explain to it all. But number 1 is what we call a contingent coupon. The coupon is paid only when the index is above its coupon barrier. Okay, so as long as the fund is still above the coupon barrier, it's going to continue to pay out its income side. Now, the automatic call after the non-call period, the investment may mature early if the index reaches its observation date level and principal returns and must be reinvested. Okay, so what am I saying there? And let me get to number 3 and I'll explain it all. The conditional barrier. At maturity, principal may be returned if the index stays above the barrier. Below the barrier, the losses can flow to full decline from the original starting level. So what does all that mean? I'm going to put it in Doug's terms very simply. So if you think of a bond, what they're going to do here is their physical holdings are largely collateral, income treasury bills, and the collective tax-awardable ETF. So what they do is they create these coupons. Think of it like a bond. It's the easiest way I've explained this. You think of a bond, and they say, we're going to pay this bond out for 6 months bond, and we're going to pay you a 4% interest. Okay? So at the end of that bond, they paid the 4%. Well, these guys do the same thing. They set up this coupon and say the coupon pays so much every single month. Okay? The what they call automatic call. After that non-call period, the investment may mature early. So if it achieves its number, so we're going to say if your $100 invested gets to $200, okay, and we're going to say that takes a year to do it. If in 6 months it gets to that level, it'll automatically call. It'll automatically mature. You've got to the maximum number. Again, always think of bond. You hit your maximum amount in the bond, it stops growing, pay out, close it out, it's done. Now, the conditional maturity. At maturity, if that principal may be returned if the index stays above the barrier. So what they also say is you invested at $100. If we have a barrier at, say, 70% or 40, excuse me, let me put it this way, a 70%, which would be basically a 30% drop. As long as it's above that 30% drop, it's paying out completely, no issues. Okay? If it drops to that 30%, it's going to call again. It's going to stop. So they're trying to put a barrier as a maturity condition, not the daily floor. So I want to make sure you guys understand that. This is a barrier. So it may fall, one day it may fall, that market conditions, but it's not designed to drop off. So the first fund we're going to talk about is going to be the Nasdaq Autocallable ETF. So let's talk about the design, the strategy that they currently use. CAIQ is a laddered income strategy built from synthetic autocallable linked to the volatility managed Nasdaq 100 index. Their primary goal is monthly income. Okay. Now, I'm going to stop here and give you the next point. The structure. A normal callable ladder is set up that you have 12 callables a year. Okay? So this can go from a monthly to a quarterly to a half a year to 1 year to 5 years, however they want to build their platforms. But always the simplest thing to think of now is a ladder. So the first rung of the ladder is your first coupon. It's your first month. So you get in January, the coupon normally will end a month out, and then that money reinvests into the next coupon, and that goes for a month out, and so on till you get to a 12-month period. Now each month the income focus is they classify where is the coupon at. Are you above the barrier point? Are you below the maturity side of it? And then they pay out the pre-agreed coupon amount. Okay? You take the coupon amount as your income, your initial investment is really put right back into the next rung of the ladder. So kind of simple. Now, CAIQ does things a little bit even more defined. They use a theoretical ladder of 52 plus synthetic autocallables. Okay, so what you're seeing here is I put in here is the position 1, 2, 3. Those are now going to be weekly. Okay, so each week it's going to adjust over and over and over and over. And then they build up what they received in those weeks to your monthly to make it work out. So that's why you get 52 different buffers, 2 different rungs of a ladder. You're taking little steps to get to the big picture. The different starting dates, the observation dates, the maturity dates all reduce reliance on one market entry point. So what they're trying to do here is allow everybody and their brother to jump in when they want to. Jump in the pool when you want. How do you want to do it? Their starting points are all different. You don't have to wait till the beginning of the year. You can do whenever you want. And then also, as a week, you have a good week, bad week, a good month, bad month, you can jump into any one of these starting points and have a new start of a ladder. Now, the typical maturity is about 5 years. Okay, the monthly observation dates is they put it in there as, and that's really, it's all terminology. That's kind of like your payoff dates. Your non-call period, okay, so how long are they going to last with it where there's no calls at all? 1 year. And then they use the auto barrier right here, as we call it 100%. Now, how does CAIQ generate its monthly income? Well, I pretty much explained to you here. Monthly distributions depend on individual auto-callable coupon conditions. Now, they're not guaranteed. Okay, so as long as your fund is above or at 70%, the coupon will be paid. If it falls below 70%, the individual callable misses its coupon point. This is why you need all those staggering different pieces of the puzzle. Okay, so on the weighted average right now, their coupons as of July 24th is weighting in at 17.77% return. Now, the 17.3 ETF analyzed distribution rate, which is paid monthly as of June 30th. So they're right on track with what they're looking at across the board. Now, the distribution rate does and does not tell you everything about a fund. It analyzes the latest payment. It does not show the mix of income, gains, or return of capital that's played into it, and is not a total return forecasting. These are why these become very confusing and harder to understand, because they take a little bit more knowledge across the board. So here's what I wanted to show people to give you a better idea. Now, as we said, they're targeting that 17%. If all the coupons do exactly what they're looking for, they're looking at about 17%. To put this more into your terms, my terms, to understand this better, what this thing has done, basically since January. Now, I know we're going to say December 23rd because they went through October, then November, and then they made their first payout in December. And then that was classified their January payout. So you can see that they've been paying out about 37, almost 38 cents on average across the board on each and every cash payout. So that gives them about a 10.48% yield, and that's a yield of year to date. Or technically, I'm going to have to say since inception because of the way we rated this. But paying out $2.60 and paying out monthly. So your dividend yield right now is about 10.48%. Now, CAIQ's growth and total return, this is where, again, total return is going to tell you more about a fund, where it sits, and so on. The trading began November 20th, as it said. The NAV came out at $25.54. It's actually gone up their NAV, so there's been no decline in this. Its assets are over $273 million, so that puts us over our $50 million number that we always want to try to stay above. And for 2026, so far, year to date, total return is 8.32%. If you take a look at the 10.54 I just told you about, that would be since inception, and their total return since inception is 12.68%. So it tells you that the income is fairly secure and safe and solid. It has the barriers that protect you in the underlying downward trends, and it's generating a decent about 10.5% distribution. So the right scorecard, the share price plus distributions equals your total return. Monthly distributions are a central part of CAIQ's return profile. The NAV alone can understate the investor's experience, and they evaluate return with distributions reinvested. So a high distribution rate is not the same as a high total return forecast. So still total returns mean a lot in these particular funds. So CAIQ's performance and the market declines. This is what you probably got your attention right off the bat. A 70% maturity barrier may support principal return at maturity until it gets breached. So when I say a 70% maturity, this is what I talked about earlier. You start at 100%. In a 20% decline on market share, the fund is still paying its coupons. It's still above the maturity barrier. It's still above the coupon barrier. So the coupon still pays its principal and the return to the maturity. If you hit 30%, your threshold, it's at the threshold. Conditions are generally satisfied if or at above 70%. So the barrier mark that it has, it's paying all the way up to a 30% drop off in the marketplace. Now, if the marketplace takes a bigger drop off, like a 35% decline at maturity, the barrier has been breached. The investor participates in the full 35% decline, not just the 5% barrier, not just below the 5%, but you are able to continue your income underneath this barrier. Okay? So even if the market takes a 30% drop, my net value, could actually go down, but my income is maintained and controlled. That's the 30-year barrier. So if you feel that you're going to have a 40%, then you're going to want to find something that is what they call a 60% barrier. Or the bigger the number, the smaller the number, the smaller the barrier is going to be, which means it pays at a higher percentage above. Now that'll change the distributions across the board. But I look at this and say a 30% drop off is likely, could happen, but I'm protecting myself up to that point. And I believe that I can still count on my income in a big 30% drop off. Now, what happens in taxes? This is another big one that people ask me about. Well, as it's gone so far, okay, they estimated the July tax estimate was 100% ROC. So return of capital. Through the fiscal year, the thing's about 97.78% return of capital. It means 2.22% is actually coming as net income. Now, none of this means anything until you get your 1099 distribution dividend tax form, because these numbers are estimated and they can change. Many companies use a high 100%, 98%, all the way down the road to give you that tax barrier. But at the end, they have to be honest and legit and tell you what the actual number turned out to be. Now, the fund cost, operating cost, 0.74%, so it's about the same price as many index covered call ETFs, which is, again, this is not a covered call program. A fixed 6% annual can reduce recovery participation. So this is what they're doing, the volatility targeting, okay? They're trying to target this thing. It targets a 35% implemented volatility. So they're trying to come back and say, boy, if we stay above whatever number we want, 35, 40%, as we just showed you, this was a 70%, they can normally still generate that good 6% annual income across the board. Let's talk about CAIQ. This is their auto-callable growth fund. So we talked about income, how to protect that. Now let's talk about growth. Now the CAIQ fund is designed for growth, not income. Okay, I'm going to tell you point blank, there's going to be no income because this just gets rolled in. Okay, a long-term capital appreciation strategy that reinvests its coupons instead of paying out current income. So all that money gets rolled back in over and over. So basically it's dripping the income back into it. That's why I say there's zero income. Growth is not a paycheck. Now this one is linked to an S&P 500 income index fund. So they're giving you that weekly ladder. They're using the volatility of the market of the S&P 500, reinvesting those coupons for long-term capital appreciation. Their barrier on this one moves up to 50%. So a big difference in their programs. Now, don't get confused. I'm going to give you this number here, this 28.75% weighted average underlying coupon. That's not 28% cash yield, guys. That's not what they're talking about. What they're trying to show you here is what they're able to grow over a long period of time. Okay? They want to grow your asset, not give you income. So this is one that just goes into your growth fund to just grow it as big as they possibly can. And once you get done, cash it out, continue over and repeat. Then what they're trying to do here is they've showed you the index back tested 10 years through March of 31st of 2026. These guys, their system, their analysis come back and said they're looking at about a 23.75% annualized growth side of it. Nasdaq's about 19.23, S&P 500 was 14.16. So about a 9% gain by using their strategy than the standard S&P 500 in back testing. Now this was not launched 10 years ago. They're using the strategy design. This was launched in April 16th of 2026 with a NAV of $27, and their assets is $95 million. So again, it got me above my 50 million threshold, so I'm happy with that. Even though it's a newer fund, we're already well past that. Let me show you what the real returns are right now. So year to date, from April to today, July 25th, we're basically looking about 3 months into this. We're looking about an 8.18% growth in only 3 months. Total return, 8.23% over 3 months. You can see from where it started here in April in the chart on the right hand side in the blue. You've seen where it had its great increases, had a drop off in June, and it's been slowly trying to recover back from that drop off, which it did until we get the new attacks in Iran and the new war and the new scare of oil prices and so on. We've had a drop off. Now it's recovery time. Am I down on that? Yes. Personally, it's a great buying opportunity because things are back down to a new rate that it gives it an opportunity to get back up to that 14% return level of total returns. So there's some positives across the board of when to buy these. Now that the performance in market declines. Now the barrier can protect the principal conditionally, but it's not a daily NAV floor. Okay, so they have done some different things to this one. As I told you, this one has a 50% maturity barrier. Okay, so if we had that 20% drop off, you're still qualified. 30% drop off, you're still qualified. This one here, they lower it to a 50% to keep the money flowing into the program. If the thing gets to a 55% decline, if we have a 55% decline, guys, we all have problems. We are going to have, that's bigger than the stock market crash of 1929. So it shows you how we try to protect this as far out as we possibly can. So risk and taxation. Now the expense ratio is still right there at 0.74. So like I said, they're right in line with most packages across the board. Now, because of this fund here is constantly reinvesting its coupons, it's a tax deferral, not tax free. Okay. But when this thing comes out, it's basically going to come to you as capital gains distributions. So we're not anticipating, you know, that as a regular basis, but it remains a possibility that this is going to come to you as capital gains, which is not bad because if it's long term, you're going to be at 0, 10, or 15% taxable on the gains of that fund. So the market exposure, you can see they're basically getting about a 1.3 beta to the S&P 500 over a long period of time. So they're actually trying to gain as much more than they can in the S&P 500. It's not a daily reset leverage, but it's a conservative buffer funded program. So it's a little confusing on that one. It's not using the full leverage that you're used to seeing, that they're trying to multiply out. But what they're doing with the buffers and the coupons, they're trying to generate more growth than the S&P 500 through their coupon using volatility. So comparing the two funds give you this scorecard across the board of these. If you want income, monthly distribution, CAIQ is that monthly distribution side. Okay. If you want growth, CAIQ is the place to go for growth. Now, they're using a 70% barrier to a 50% barrier. So that's a satellite income allocation. This is not something you're putting all your retirement into. This is a satellite. This is protecting part of your portfolio. Okay? That you're still in, and it's really more protecting your income in that portfolio. The premier risk is treating a 17% distribution rate as a guaranteed return or assuming that the barrier stops NAV declines. It's not going to stop your NAV decline. So it's not going to stop your portfolio value. Remember, NAV is net asset value. It's not going to protect your value from dropping. What it's going to do is protect your income. You're going to consistently get a stable income in rocky times. Same thing with CAIQ. CAIQ is for a long horizon growth, not a short term or protect you from a daily drop off. So the question is it retirement suitable and what's the risk assessments? Now, neither fund can be treated as a completely safe retirement investment, nor is anything. But CAIQ is that monthly income. It's a diversified portfolio. It's a potential satellite in a broader income allocation. It's not emergency cash or a treasury replacement. It's not a guaranteed bond allocation or a sole income source. It's an income strategy. So what I personally, like I said, I use that for. I put so much as a satellite, I put so much income into it that can generate income in troubling storms. It helps fill in what I will lose or things will happen to my other portfolio of income category. Okay? So I'm protecting it in those big drop-offs. So if we get a 20% drop-off, you're going to see your income dramatically drop as well. This is still going to pay consistently. So I have a little bit more into that buffer where I want to play my numbers at. I think that 70% is more than sufficient across the board. CAIQ is your growth bucket. You want to continue to grow your funds. You want to continue to grow your package up. And this is just basically doing a drip inside your portfolio to get bigger and bigger. But the growth bucket for assets, not needed for many years. This is not something that you're going to do like everything we talk about with drip. You're not going to be something is 6 months from now, pull all the money out. You're going to let this thing sit at 12 months, 24 months, longer periods of time. It's not a retirement paycheck. Remember that. And I'm going to tell you, it's extremely new. So we got to make sure we get the history to watch through. Now, these work as counterparts. Okay. So I use them equally, income and growth. They are swaps and derivatives. They do have that valuation and that liquidity. They both broke through that barrier. These are barrier conditions. So you see one at 70%, one at 50%. Now they are new funds. It's not new strategies. It's not new to the markets. These guys are new to the markets. So there've been some history out there how these things work. So the final verdict in building a resilient portfolio, a 20 to 30% drop is really survivable when you plan. Don't depend on selling at the wrong time. You're going to want to have cash and treasury reserves. That's we'll call it your safety net at all times. That should be in your foundation type fund. You need dependable income sources built that paychecks. And that's where these funds come into. You have your income funds, but you're going to want some dependable income. This is giving you income into troubled times. You want diversified growth. This is going to help you grow coming out of that 20, 30% package because you're still basically rolling your income, dripping it back into increased growth. And positioning sizing. There's no complex strategy controls the outcome, but you can always balance these things out as your portfolio changes. Remember, yield is a math number. Retirement planning is what you want. Total return and risk management across the board. Guys, let me know what you think about these things. Let me know what you think. If you like it, hit that like button. Leave a comment down below. If you own these, let me know. How do you think they've been working for you, and how do you use them in your portfolio? Also, don't forget about our 40-ounce travel mug. Like I said, they've been selling fast. We're already on our second load, our second order of these coming in to get them out. And thank you again for supporting the channel with this. There's other ways to support it. If you want to do Patreon, get our monthly newsletter in Patreon. You can join that. All different ways to support the channel. As long as we continue getting the support, we keep putting these videos out, and we don't have to get advertisers. We can stay unbiased across the board. Thank you for watching, and we'll catch you next time.